Buying an established business can be one of the smartest ways to become an entrepreneur. Instead of starting from scratch, you're acquiring a business with existing customers, proven revenue, and operational systems already in place. But the process of buying a business in Australia involves multiple steps, significant due diligence, and careful decision-making. Get it right, and you could be setting yourself up for financial success and independence. Get it wrong, and you could be buying someone else's problems. Today, we're walking through the complete process of how to buy a business in Australia, from initial research and preparation all the way through to final settlement and taking the keys. Whether you're a first-time buyer or looking to add to your portfolio, this guide will help you navigate the journey with confidence. Before you start looking at specific businesses, you need to prepare yourself both financially and strategically. This preparation phase will save you time, money, and potential heartache down the road. First, conduct an honest assessment of your financial position. How much can you realistically afford to invest? Most business purchases in Australia require a combination of your own capital and external financing. Generally, banks want buyers to contribute at least 20 to 30% of the purchase price as a deposit, though this varies significantly by lender, business type, and risk profile. But the purchase price is just the beginning. You need to factor in all the additional costs beyond the business itself. Legal fees for contract review and advice. Budget $3,000 to $10,000 depending on complexity. Accounting fees for financial due diligence and structuring advice. Another $2,000 to $8,000. If you're using a buyer's agent or broker, there may be fees there as well. Stock take costs, if inventory is involved, and critically working capital to operate the business during the transition period. Many first-time buyers underestimate these additional costs and find themselves undercapitalized after settlement. A good rule of thumb is to have an additional 10 to 20% of the purchase price available for transaction costs and working capital. Next, clarify your search criteria. What type of business genuinely interests you? Do you have industry experience, or are you looking to learn something completely new? How involved do you want to be? Are you seeking a hands-on owner-operator role where you're working in the business daily, or more of a passive investment where you hire managers? What geographic area are you considering? Are you willing to relocate, or do you need something within commuting distance? What's your risk tolerance? Are you comfortable with a turnaround opportunity, or do you want an established, stable performer? These questions might seem basic, but they're crucial for focusing your search efficiently. The Australian market offers thousands of businesses for sale at any given time, ranging from $50,000 cafes to multi-million-dollar manufacturing operations. Without clear criteria, you'll waste months looking at unsuitable opportunities. It's also wise to start building your advisory team early in the process. You'll need a good business accountant who specializes in acquisitions, not just a tax accountant, but someone who understands business valuations, deal structuring, and due diligence. You'll need a lawyer experienced in business sales contracts, commercial law, not just residential conveyancing, and potentially a business broker or buyer's agent who can help you identify and evaluate opportunities. These professionals will be invaluable throughout the process, and having them in place before you find a business means you can move quickly when the right opportunity appears. Finding the right business requires a combination of public search and professional networks. Start by exploring online business for sale platforms. In Australia, the main platforms include businessesforsale.com, BizX, and state-specific sites like businessesforsale.com.au and local broker websites. These listings provide basic information about available businesses, industry, location, asking price, and general performance indicators, though detailed information is limited until you express serious interest. However, many of the highest quality businesses never appear on public listings. They're sold through broker networks, direct approaches, or off-market transactions. Sellers of successful businesses often prefer confidentiality and discretion, so they work with trusted brokers who have databases of pre-qualified buyers. This is where working with a business broker or buyer's agent can provide significant advantage. They have access to opportunities before they hit the public market and can match you with sellers looking for buyers who fit specific criteria. Perhaps someone with your industry experience, or someone who shares the seller's values about employee retention. When you identify interesting opportunities, request the information memorandum, also called an IM or info memo. This is a detailed document prepared by the seller or their broker that outlines the business's operations, financial performance, market position, and sale terms. You'll typically need to sign a confidentiality agreement or non-disclosure agreement before receiving this information, which is standard practice to protect the seller. Review these documents very carefully. Don't just look at the headline numbers, dig deeper. Look at revenue trends over the past 3 years, not just one good year. Examine profit margins and understand the key cost drivers. Identify the business's main revenue sources. Are sales diversified across many customers, or is the business heavily dependent on 1 or 2 major clients? Assess how dependent the business is on the current owner's personal relationships, skills, or reputation. If the owner is the face of the business and customers are loyal to them personally rather than the business itself, that's a significant risk factor for you as a buyer. Look for red flags in the information memorandum. Declining sales year over year, customer concentration, where 1 or 2 customers represent the majority of revenue, lease issues, short remaining term, expensive rent, or landlord uncertainty about assignment, regulatory problems or compliance issues, unusual add-backs or adjustments to profit that seem aggressive or questionable. Here's a critical piece of advice: don't limit yourself to one opportunity. Serious buyers typically review multiple businesses simultaneously, comparing options and understanding market pricing for similar businesses. This comparison shopping helps you recognize a genuinely good opportunity when you find one, and it provides valuable negotiating leverage. You can move quickly on the right deal without appearing desperate. Take notes on each business you review. Create a simple spreadsheet comparing key metrics, asking price, revenue, profit, industry, location, growth trends. This organized approach helps you make better decisions and prevents you from confusing details between different opportunities. Once you've identified a business that interests you, conduct an initial evaluation before making a formal offer. This preliminary assessment helps you determine whether it's worth proceeding to full due diligence. If possible, visit the business during operating hours, observe customer traffic and buying patterns, watch employee interactions, are staff engaged and professional, or do they seem unmotivated? Look at the general condition of premises, equipment, and inventory. Talk to the current owner and ask probing questions. Why are they really selling? The stated reason might be retirement or new opportunities, but probe deeper. Are there challenges they're not mentioning? What do they see as the biggest obstacles facing the business? What opportunities have they identified but not pursued? How has the competitive landscape changed in recent years? Review the financial statements in detail with your accountant. In Australia, many small businesses operate on cash basis accounting rather than accrual accounting, which can complicate analysis. Your accountant should normalise or recast the financials. This means adding back the owner's salary, removing non-business expenses like personal vehicles or family phone plans, and adjusting for one-off costs that won't recur under your ownership. This normalisation shows the true earning capacity of the business, what we call sustainable discretionary earnings, or SDE. For a business with an owner-operator, SDE is typically calculated as profit before tax plus owner salary and benefits plus interest, depreciation, and one-off expenses. This is the income available to you as the new owner. Understand the valuation methodology being used. Different industries use different multiples and methods. Retail businesses might sell for 1.5 to 2.5 times annual EBITDA. That's earnings before interest, taxes, depreciation, and amortization. Service businesses might command 2 to 3 times EBITDA, especially if they have recurring revenue or long-term contracts. Location-based businesses like cafes, restaurants, or beauty salons often trade at 2 to 3 times the sustainable discretionary earnings. Manufacturing businesses with significant plant and equipment might be valued on a combination of earnings, multiple, and asset value. Your accountant can help you understand whether the asking price aligns with market norms for similar businesses. They can also show you the return on investment you can expect based on the purchase price and earning capacity. When you're ready to make an offer, structure it thoughtfully. Most offers in Australia are conditional, meaning they're subject to certain things being satisfied before the sale becomes binding. This protects you while you investigate further. Your offer should clearly specify several key elements. The purchase price. Be specific about the total amount. The deposit amount, typically 10% of purchase price, held in trust. The settlement timeline, usually 30 to 90 days from acceptance. what's included in the sale, all plant and equipment, intellectual property including business name and trademarks, customer lists and databases, existing stock valued at cost or market value, goodwill, include appropriate conditions. Finance approval within 14 to 21 days is standard. A due diligence period of 14 to 30 days. Depending on business complexity, this is your chance to investigate thoroughly. Landlord approval for lease assignment if premises are involved. Verification that financials are accurate. Transfer of all necessary licenses and permits. Don't be afraid to negotiate on price, but do it professionally and with justification. Asking prices are often negotiable, especially if the business has been on the market for several months, if your preliminary review identified issues, or if market conditions favour buyers. However, avoid insulting lowball offers that will damage the relationship and potentially kill the deal entirely. If you genuinely believe the business is overvalued, present specific reasons why. Comparable sales data, identified risks, or necessary capital expenditure to bring equipment up to standard. Remember that price isn't everything. Sometimes negotiating better terms, longer handover period, vendor finance, deferred payment structure, or specific warranties from the seller can be more valuable than a small price reduction. Once your offer is accepted, the due diligence period begins. This is your opportunity to verify absolutely everything the seller has told you and to uncover any issues that might affect the business value or your decision to proceed. This is not the time to rush. Thorough due diligence is your best protection against buying a problem. Financial due diligence should be comprehensive. Review actual bank statements for the past 12 to 24 months, not just profit and loss statements prepared by the business's accountant. Bank statements don't lie. They show actual cash flow, real revenue, and genuine expenses. Cross-reference them against the reported revenue in the financial statements to ensure accuracy and identify any discrepancies. Review BAS statements. That's business activity statements submitted to the ATO. These quarterly reports show GST collected and paid, which is another way to verify revenue. Look at tax returns for the past 3 years. Review all correspondence with banks and financial institutions. Check for any existing loans, debts, or financial commitments that will need to be addressed at settlement. Examine all major contracts that are crucial to the business. Supplier agreements. Are they transferable, or will you need to renegotiate? What are the terms and pricing? Customer contracts. For B2B businesses, review all significant customer agreements. How long do they run? Are they exclusive? Can they be assigned to you? Service agreements for equipment, software, or maintenance. What's included and what are the costs? Pay special attention to the lease document if the business operates from leased premises. The lease is often as important as the business itself. Is it assignable to a new owner, or does the landlord have discretion to refuse? What are the current terms? Rent amount, outgoings, annual increases. When does it expire? Are there renewal options? How many years are remaining? What's the rent compared to current market rates for similar properties? For many businesses, especially retail or hospitality, an unfavourable lease can make the business unviable. A lease expiring soon with no renewal option guaranteed or rent significantly above market rates represents serious risk. Conduct thorough operational due diligence. Understand the workflow, systems, and processes in detail. How does the business actually operate day to day? What systems and software are used? Are they owned or licensed? Can they be transferred? Identify key employees and assess their likelihood of staying after the sale. What are their skills, experience, and compensation levels? This employee assessment is critical. Many business failures after acquisition occur because key staff leave and the new owner can't replace them or doesn't have the skills to fill the gap. If possible, have confidential conversations with key employees, with the seller's permission, to understand their intentions and concerns. Review all licenses, permits, and regulatory compliance requirements. Depending on the business type, you might need liquor licenses, food handling permits, trade licenses, professional certifications, or industry-specific registrations. Verify these are current, in good standing, and transferable to you as the new owner. Check for any outstanding compliance issues, regulatory disputes, or historical violations. Assess the physical assets thoroughly. If significant equipment is included in the sale, have it inspected by a qualified technician. What's the age and condition? What's the remaining useful life? Are there upcoming capital expenditure requirements for replacements or major repairs? For businesses with significant inventory, conduct a thorough stock take. Verify quantities, Check for obsolete or slow-moving stock and assess quality and salability. If you're acquiring real property or a long-term lease, consider engaging a building inspector to identify potential structural issues, needed maintenance, or compliance problems that could cost you significantly after purchase. Legal due diligence should include comprehensive searches for any legal claims, disputes, or litigation involving the business. Your lawyer will conduct database searches for court judgments, bankruptcy proceedings, or regulatory actions. They'll review employment contracts and check for any unfair dismissal claims, workplace disputes, or industrial relations issues that could become your problem. Check intellectual property ownership. Does the business actually own its trademarks, domain names, and proprietary systems? Or are there licensing arrangements that might not transfer? Are there any IP disputes or infringement issues? This due diligence phase typically takes 2 to 4 weeks for straightforward businesses, though complex operations may require 6 to 8 weeks or longer. Don't feel pressured to rush this process. Sellers sometimes create artificial urgency. Another buyer is interested. Or, this price is only good this week. If the seller is unwilling to provide reasonable time for proper due diligence, that's a red flag in itself. If you discover issues during due diligence, you have several options. You can renegotiate the price to reflect the newly discovered risks or required investments. You can ask the seller to remedy the issues before settlement. You can proceed anyway if the issues are minor and manageable. Or you can walk away entirely if the problems are serious enough. Your conditions should allow you to withdraw without penalty if due diligence reveals material issues that weren't previously disclosed. Securing finance for a business purchase in Australia typically involves either traditional bank loans, alternative lenders, or creative financing structures. Banks will want to see strong historical financials from the business, evidence of your ability to manage it successfully, and adequate security for the loan. Most business loans require both the business assets as security and personal guarantees from you as the borrower. Your lender will conduct their own due diligence, including independent business valuation and financial analysis. They'll assess the business's ability to service the debt from its cash flow. Typically, they want to see cash flow at least 1.2 to 1.5 times the debt service requirements. Prepare for this by having all financial documentation organized and ready to provide quickly. Delays in finance approval can jeopardize the entire transaction if your conditional period expires. If traditional bank financing isn't available or doesn't cover the full amount, consider vendor finance, where the seller provides part of the funding. This can work well for both parties. The seller receives a higher total price over time with interest, while you can proceed with less bank debt and potentially more favourable terms than a bank might offer. The seller's motivated to help you succeed because they want their ongoing payments. However, vendor finance agreements need careful structuring to protect both parties' interests. You need clear terms about payment amounts, interest rates, what happens if you want to sell the business during the vendor finance period, and what security the vendor has. Once finance is approved and due diligence is satisfactory, you'll move to settlement preparation. Your lawyer will prepare or review the contract of sale, which should include several critical elements: the complete asset list, everything included in the purchase, the final purchase price, and how it's allocated between different asset classes for tax purposes, the settlement date and location, any warranties from the seller about the business's condition, financial accuracy, or legal compliance. Crucially, include a restraint of trade clause, also called a non-compete clause. This prevents the seller from starting a competing business in the same geographic area for a specified period, typically 2 to 5 years depending on the industry. Without this protection, the seller could potentially open a new business next door and take all their former customers with them, leaving you with an empty shell. The allocation of purchase price between different asset classes affects your tax position. For example, amounts allocated to plant and equipment can be depreciated, while amounts allocated to goodwill may qualify for small business CGT concessions. Your accountant and lawyer should work together on optimal allocation that's fair and defensible. Before settlement, arrange appropriate insurance coverage. You'll need public liability insurance, professional indemnity, if applicable to your industry, property insurance for owned equipment and inventory, business interruption insurance to protect against unexpected closures, and potentially key person insurance. Most landlords and lenders require proof of insurance before they'll allow settlement to proceed. On settlement day, all funds transfer, all contracts are signed and exchanged, and ownership officially changes hands. You'll receive keys, access codes, alarm codes, supplier contact lists, customer information, and all the documentation needed to operate. This is also when you're introduced formally to employees, if they weren't already aware of the sale. Most sale agreements include a handover period, where the previous owner trains you and facilitates the transition. This might be 1 to 4 weeks, depending on business complexity. Use this time incredibly wisely. Shadow the owner, learn the systems, understand the nuances that aren't written in any manual, meet all the key people, observe how they handle different situations. This transition period often determines whether your acquisition succeeds or struggles. The more you can learn directly from the previous owner, while they're still available and motivated to help, the smoother your path will be. Buying a business in Australia is a complex process, but following a systematic approach dramatically increases your chances of success and satisfaction. Take time in the preparation phase to clarify your goals and build your financial capacity. Be thorough and patient in your search. Don't settle for the first opportunity that appears. Conduct rigorous due diligence because this is where you truly protect your investment and avoid costly mistakes. Secure appropriate financing with realistic terms that don't overburden the business, and plan for a proper handover period to ensure continuity and a smooth transition. Remember, you're not just buying assets and revenue streams, you're buying someone else's legacy and your own future. Both sides of that equation deserve careful, thoughtful consideration. Done right, buying an established business can be the foundation of financial independence and personal fulfillment. For more insights on buying and selling businesses in Australia, visit offmarketgroup.com.au.